Futures point to a higher open on declining borrowing costs at an auction of Italian bonds, which eased concerns on the European debt crisis. Asian markets finished lower as Japanese data showed that the country's industrial output fell and deflation deepened. In corporate news, Bank of America considers more asset sales to raise capital, according to a report from the Wall Street Journal. I'm Jill Malandrino, and the morning call starts right now.
Good morning, I'm Scott Redler, Chief Strategic Officer at T3Live.com.
And I'm Jill Malandrino with TheStreet.
And I'm Brian Sozzi, Real Money Contributor.
And today we bring a very special edition of the Morning Call as we have Scott and Brian, who are co-contributors on TheStreet's Real Money Pro. So yesterday we saw another flat day, light volume, as expected this time of year, but it's not time to fall asleep behind the wheel just yet. We have Italian bond auctions tomorrow, and we have a slew of economic data, including manufacturer index, coming out tomorrow.
Yeah, so I think like Thursday is the last big hurdle, the last piece of news that everyone's starting to get enamored with. How come the Italian yields haven't gone down, you know, with that big move that the ECB did? So I think that if we can get that Thursday out of the way and it's just in line, the Bears are going to have absolutely nothing to hang their hat on, and we could get that follow through with new flows into the beginning of next year, considering that right now the Bulls really have the ball to lose, and they have the momentum ever since what was I trying to say? The market ignited back last Tuesday.
So, Brian, from a fundamental perspective, what are you looking at for the next year, day or two?
Fundamentally, I think you're seeing low volume, 50 to 55% below average. You're seeing, like Scott mentioned, everything that's going on with these Italian debt auctions, yields. There's still yield concern out there. I wouldn't mind pulling some off the table. Ultimately, maybe late Thursday afternoon, maybe get positioned for ahead of the next jobs report.
Okay, so let's take a look at the charts from yesterday and how you position yourself into the end of the year.
So the chart of the S&P tells you this. I agree with Brian that we've just had about almost a 5-day move. So you never want to be fully invested on the 5th day. You want to take the meat and potatoes out of the trade, but we can continue, so you should continue with the trade. So if you look here at the S&P, you will see this is when the trade ignited. This was last Tuesday. This is when we broke this small descending channel. You guys remember this trade, this monotonous back and forth where guys were getting really frustrated? Well, the trade changed right here, that Tuesday. Then you had the Wednesday Oracle disappointment where we held the top third, where you could have positioned and bought that dip. And now you've had 3 up days. And what's important here is now we're back above the 200-day moving average. We're above this small little downtrend. And you know what? If we can go sideways the next 2 days and then get past that Italian bond yield or bond auction or whatnot, you could see, a move. I would say 1277 by year end isn't out of the picture or not too optimistic, but I think in order to get above this 1292, that October high, we're going to need some new flows coming in the first or second week of January, and that's what typically happens. Everyone comes back, everyone gets their new allocations, and if they can't stuff them in the first few days of the year and just sell them and short them, they're going to have to buy them, and that could take you above 1292, and that can give us momentum to about 1320, 1340 in the first quarter of 2012.
Scott, another interesting chart we've been looking at is the Dow, and how that's played into overall support for the move that we've seen over the past week or two.
Well, I would say, that's kind of frustrating. We're traders. We're actually, we're fundamental technical, but, we like to look at sexy stories, things that move. And unfortunately, tech's not leading the way right now, which isn't, it's not so bad. Same way with the volume's light. And, if you're short and volume's light, you can still get hurt. And if you're long a stock that goes up on light volume, you can still make money. So it's just this environment. It's just not perfect. So when the Dow leads, it's almost good for mutual fund owners and 401k owners, but it's not necessarily that great for traders. So if you look here at the Dow, you will see that we're already above that October high. So if you look here, this was that same igniting bar that broke us out of this monotonous descending channel, and now we're already above that October high. So that's why we're seeing some strength in some other groups besides just tech, and that's why we have Brian here to help us go over what's going on with consumer staples.
So moving into more unsexy names, healthcare, utilities, and consumer staples have led the way as the 3 top sectors for 2011, which is the focus of our sector spotlight, that being consumer staples. Brian, what's your fundamental outlook for 2012? Because this group is off the charts this year.
Historically, consumer staples are not sexy. There's no sex appeal. But right now, in a land where these companies continue to raise their dividends and the yield is so attractive, that's what ultimately makes them sexy. At least for me, I'm inclined to be a little contrarian here and take a little money off the table. I think consumer staples have rallied so hard at this point. You maybe want to look to rotate out of them into something maybe like the Russell ETF, small cap, because if the domestic economy is improving to the extent that all the jobless claims data and even the ISM numbers suggest, you want to be in some of those smaller cap names. And if I had to choose, I would chase Procter & Gamble here. But again, I wouldn't mind, taking some profits off the table.
Right. So if you look at VDC, which is a consumer staples ETF, from a trading perspective, do you follow through with that momentum, or do you take when do you take money off the table?
Well, there's two ways to look at it. Right now, this group has been the strongest, and they seem a little bit overbought on a short-term basis. But on a monthly and a weekly chart, these things haven't done anything in 3 to 4 years, and they almost look ready to explode, which could support the actual market. So if you look at the VDC, which is a new, I guess, ETF that's been around about 5 years for the consumer staples, you will see that you had a big move, okay, in the end of November, held higher, nice little flag, and now it's starting to break above this 82. This should see new highs into January. If you look at the monthly on it, you will see that it's just starting to go. So there's a lot of support there, and let's take a look at some stocks, okay? So what'd you say?
Right, so if you look at Church & Dwight, which outperformed the group this year, it seems as if raw material cost hasn't impacted the same at all relative to its peers. So CHD, does this trend continue?
That's why, it's an ultimate oddball move, not just in CHD, also with the rest of them too. These are global multinational companies with oil over $100 a barrel. So that even gives me even more inclination to view this latest move with a little bit of skepticism.
Right.
Well, it just goes to show that the market tries to confuse and make everyone look as poorly as possible. So if you look at first a few of these charts, CHD, if you look here, you will see that it is strong and it is starting to break out of this move. But if you do look here, stock really has been in a tight range since September. So that's 4 months, hasn't done anything, just started to go. You look at a monthly chart of this stock, and this is actually a good performer. I haven't even watched this one in a while. It's got a nice, easy slope, about 45 degrees. So there's a lot of people that have owned this and are doing very well. I do think, though, that P&G is a different story here. You look at the daily chart, just starting to go, but if you've held this thing for a few years, nothing, right? How long is this little base here? This is from, 2009? So you have a base going across for about almost 3 years, and it's just starting to go. So if it can get above this 67, and people still want the dividend, you can get a nice methodical move back to the highs here of around 75.
So moving along to Kraft, it recently had a 52-week low, but it's still kind of trading in the middle of the pack relative to performance and in terms of multiple, a little bit different in the consumer staple space where it's not personal care products, this is more focused on food. So what's your thoughts on Kraft?
Kraft, again, also I'm not inclined to get too particularly bullish on as well. My sense is that the domestic economy is improving, and I could see inflation starting to come back and impact Kraft. It's not going to be to the extent it was earlier this year for many food companies, but even with Kraft, I think you're seeing a lot of the bullishness coming off of what they're doing to split the company in half.
Right.
Well, so the chart tells me that there was one trade here. Now I would think it's just a hold. If you look here, you'll see that there was a spot that could have been tradable above 37. You had a big move from 34, came up, held above this entire resistance going sideways, and it just started to go again. So on a daily chart, looks like it's underway as a trade. It could have been good around 37. You go to the monthly chart, and again, you look at something like Kraft. This hasn't done anything in, what's this? This is what, 2002? So it's just starting to get above the 2002 level. So this is some pretty heavy accumulation by whatever those mutual funds that love this type of thing, and they're just starting to get paid. So this thing, if the market continues also, you could see 42 to 44 at some point next year.
And rounding it off with KMB, Kimberly-Clark, 72 is a very key level in this name, and it broke above that.
Let's take a quick look here. KMB, go to the daily chart. And you will see that nice tradable move here. Above 72, gave you a quick move right out of this resistance type of zone, and now it's just slowly ticking up. 73.82, not bad. Take a quick look at the monthly here. You go to the monthly here, it's a little bit more volatile than the last few that we saw, and it looks like it's about to spread its wings a little bit and continue. So it's a little unconventional that all of these multinationals are doing so well, but I think low PEs combined with the dividend yield, names liquidity, I guess that's the thesis for some of these funds.
So Brian, for the last 2 days of the year, for PMs that are looking to kind of chase performance, if your books are closed, I can't imagine why you would possibly want to open them up, but do you think these catch any more action, or it's going to be relatively level?
I think it's just going to relatively, weak volume moves to the upside. If you're inclined to chasing names even more, I even want to make a broader point here. You're seeing household state, these companies move to the upside so strongly, despite, large warehouse centers in the U.S. not really ramp up their square footage. So it really is a strong market share gain here at this point. A lot of price competition, not necessarily space that I'm, particularly enthused about.
Okay, all right, we're going to jump into a quick commercial, and when we get back, we go into the trenches.
Hi, I'm Sean Hendelman, CEO of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
Welcome back to the morning call. We're going to jump into the trenches with the energy names. And what's interesting here is these have typically been played for the dividend that's attached to the stocks. I mean, you have the oil volatility, but these have been sort of safe havens this year for the dividend names. But what's interesting is you're starting to see more of the growth story as these major oil firms are looking for new shale plays. So I think it's something that we have to look for 2012. But let's kick it off with the XLE and see what the charts are telling us.
I think it's a good thesis for 2012. There's definitely a bang for the buck here. You get dividend and you get growth, so that could be a better move for traders. So if you look here at the XLE, you will see that the chart right now is still consolidating. You know, you had a big move lower with that October low. You came back up and it's been going sideways, you know, pretty nicely. Okay, we're coming back to the upper end of the range. I would say, you know, tier 1 at best in this group, but there are some leading stocks doing better. Once this gets above this 72 and reclaims the 200-day moving average, I think that this could grab some, it could be an oil slick moving higher into the first quarter of 2012, and then the next resistance is really like 76 to about 80. So watch this 72 as big resistance right there.
Moving on to one of my favorite names, and it was actually one of our options for profits plays that we did really well with Chevron, ticker CVX. It has an attractive dividend yield. It's been a great growth story for this year, and they're looking to expand again with that shale. So they're doing some M&A within the shale space.
Yeah, this one definitely shook it up a little bit when they came out with that news that they had the spill, and just look at this crazy down move. It wound up holding higher versus the low, came back up to test this downtrend, held higher, and then had a pretty explosive move in the past 4 or 5 days. So when the market wants to go, lately this wants to go with it. So it's already above this downtrend. It's a little bit overbought right here. I'd love to see it go a bit sideways, and if it goes a bit sideways, this stock could make another additional move into the first quarter 2012, and that 110 is going to be the resistance it has to get above.
Let's take a look at ExxonMobil and Conoco together. These are, these companies are just tremendous. Exxon alone generates $100 billion in revenue a quarter, and they're safe dividend plays. You're not getting fired for having these in your portfolio. So Brian, from a dividend perspective, what are you looking for when you invest in these energy names?
In terms of dividends, obviously these dividends are extremely sustainable. I want to see, given the cash flow characteristics of the business fundamentally, who has the greater propensity to raise them as aggressively as possible. I was looking at the XLE chart that Scott pulled up, and I'm having flashbacks to the NASDAQ. When I'm seeing on NASDAQ, these companies have not gotten a lot of love, and I think they do deserve a lot of love. Improving domestic economy, oil over $100 a barrel, geopolitical risk, you have to have exposure, and those two are some of the best two names.
So Scott, if we look at ExxonMobil, is there any more growth within this stock? I mean, how much better can it get?
Well, there's been two really good buy areas that we actually outlined here on Morning Call. If you take a quick look, XOM, here they are. It actually trades very well technically. Look at this resistance area. It almost like was a brick wall, and then once it got above the 74, you had a quick move to 82. And then if you missed this move, it came back and retested it, came back up to that prior resistance, and then held higher here, went sideways, and then this 82 was another nice buy point, another nice area to play for a breakout. So you had a 4 or 5 day move just like Chevron. Seems like it's petering out. I actually, for a cute trade, I went short a little bit yesterday, and I'll see what happens here. I do think that I'd love to see a pullback to around 83 or so. Which I'd love, we all have things we want to love to see, but if it doesn't, if it goes above yesterday's high, I'll cover. But little pullback, and then I think this stock is on the move in 2012 with some of those other names.
Let's round it off with Marathon, ticker MRO. Analysts at Oppenheimer took this up December 5th. They expect continued upward momentum to go into 2012.
All right, well, this chart looks a little bit different. They haven't seen the love that Brian likes to see. So if some love comes back to MRO, you will see it start to extend. So if you look here at the chart, it still has some room. It did break this small little downtrend right around here, and this was going into a few weeks back. So this was probably a better entry around 27, but it's already also taken back its 200-day. So I guess if you look a little bit longer term, there is room in this MRO to get back to 32, but then right around that 32, there is such a big line of resistance. So at this point, there is room to go, but you just have to trade around that position.
Let's move along to quick hits for some quick cash. We're going to kick it off with Google, which is Scott's 2012 pick of the year. But Brian, what's your thoughts on Google? I feel like names like a Google and Apple, they're not just technology. I mean, you also have the consumer aspect in there as well.
That's certainly correct. A lot of retailers that I actually have sector coverage on, they're investing a lot of technology in the back end of their places. It's not just opening stores anymore. It's hiring the people to improve their search results. And anytime I think search results, I'm obviously thinking about Google. I'm inclined here to get a little more into Apple at this point. I know it has not received any love at all by the street lately, but I think that's a name you have to own. When I see retailers putting iPads in the hands of their employees, that gets me excited.
Right, and then why is it your 2012 pick of the year?
Well, you touched on Google and Apple, and both have been the best vehicles to me over the course of the past week or two. So Google yesterday, they say, why are you at work? But the reason why I'm at work is because you get a chart like this and a breakout like this, which pays the bills as you go into the new year. So if you look here on Google, this might not look like much, but we've talked about 633 to 635 so many times here, and finally, it broke above it. So this was a nice trade. If you've been accumulating it at this upper area, you're getting paid as an investor also. And I do think you can get some follow through. So for Google, above yesterday's high of 644.49, and it can continue. And the really exciting point here is look at the monthly chart. This stock has done absolutely nothing since 2007. That's when the high was. So you've been in a 3 to 4 year consolidation. It's just starting to get above this tight little range. So it starts to extend here. The measured move from the cup here of about 300 to about 640 is about $300. I'm not even going to say $300 on top gives you $940. I just think we get above $750, and that'll be a nice thing to own for next year.
Moving along to ISRG, that's a name we've been trading more frequently over the past 2 weeks.
Well, it just shows you that you can have a name and be an investor. Like ISRG has been on the list. We've said that Santa could knock on that door many times. It is now at historic highs. Look at ISRG. Unbelievable. Look at the daily too. Nice breakout. This is why people are here during the holidays and not just on the beach. Right now we got above 447. This is almost a 20-point move extending above a key resistance area. So at this point, if you're in more than a tier 2, I would definitely take some off, but just stay with some because new money will love this thing, and it's just been a winner across the board.
Moving along to the big banks and the brokers, let's take a look at Goldman Sachs. There's nothing really sexy to say about the banks here. What's your thoughts in terms of these major institutions?
I have to respect the market here. I cannot fight the tape in these financial stocks at this point. I know Bank of America is making the rounds in the news again. Goldman Sachs too. The stock has been slaughtered. Financials are down, I think, about 20% as a group this year. They need to show me something. I know most of them trade below book value. If anything, if I want to go back in this place, maybe I look at a key bank or some of those regional banks.
More of the regionals, right?
Correct.
So what's your show me level with Goldman on the charts?
Goldman's given us some trades. It just hasn't given you anything more than just a trade. If you look here at the chart, you will see, this was the last low in October. It went from 85 to as high as 115. Then this was that line in the sand that broke that uptrend, corrected again. Then you had a nice little move again, went as high as 105, but it was a lot more shallow than the last one. And then look how small this little move was. So it's showing you how these rallies are less. So, if Brian wants to see something here, what you want to see is it has to get above 95, and I don't want to see it go any lower than yesterday's low, because if it continues here, this little support level is going to be taken out into 2012, and that's not going to be good for the market.
Moving along to Visa, the consumer has certainly surprised me this year in terms of the strength. Are people not paying their mortgages and allocating more money towards consumer retail? But this name has made an amazing move over this entire year. What are your thoughts?
I'll be honest, I don't know how the holiday season is going to pan out at this point. I said we saw lots of price competition. We saw throngs of people shoved through the door at Walmart on Black Friday. But the past couple of weeks, they were sandwiched. The traffic wasn't as consistent as you would think. A lot of online spending. I do think Visa would be the one to look into in retail in a pullback, just because I think these are, you're using Visa cards to pay for your gifts.
Right.
Online, and especially with Amazon.
And you don't have to worry about mortgages, or
Exactly.
dirty debt. So this one has been something acting strong all year, and this was one that just got marked up a little bit into year end. So if you look here at the chart, Visa's been a great trade. Broke above this 97. Yesterday, did a small outside day. So this is one of those days to take notice where it pushes through a high, closes a little negative. So this is a short-term sell signal. So like you said, buying on a pullback would be smarter, Brian. So perhaps you could buy into this zone, and then it could continue because you go to the monthly chart of Visa, and it shows you how this has been a new issue. When did it come public? Like 2008. It's paid you to actually be involved, and it's at historic highs. So it shows you that everyone says you can't be a stock picker. If you picked Visa, you didn't have to just be a trader.
This is one of my favorite calls to round off the quick hits. Whirlpool, one of my favorite plays or derivative plays. So if we look at SHLD yesterday, Sears Holding, what a mess that absolutely was.
Poor
You
Eddie.
upgraded this stock in November or whenever that was. It was just ugly. There's nothing great that you can say about it. There really is no value anymore in the stock. So we were speaking yesterday in terms of Whirlpool, how it affects that particular name. What do you see in the balance sheet?
Well, first of all, on the topic of Sears, I think the announcement yesterday was extremely embarrassing at this point. And I think everybody did a lot of dancing yesterday around the topic. And the topic is, their world may not have Sears in 5 to 10 years, Sears or Kmart. But in terms of Whirlpool, stock was down about 8% yesterday. 6 to 8% of their revenue annual over comes from Sears. No other, in terms of Home Depot and Lowe's, no other outlets are aggressively opening stores. That means no more appliances to go into these stores. Now, I would say this for Whirlpool. I used to have coverage on it, and they've done a real great job consolidating their manufacturing facilities. So there's a lot of, they've streamlined a lot of their business. So You know, if the international story comes back, I could get excited. Right now, I'm definitely not fighting this tape.
Right. So with the chart, is there any opportunity at all in there? Like any small
Let's take
plays?
a quick look because yesterday had a pretty devastating down move. If you look here, you will see that you know, you have a wide range bar that just took out the last 4 days of this rally. So it took a lot of people by surprise. The last line of defense here for Whirlpool would be this big support level down at 45. You know, so if it's a little over emotional, you know, from yesterday because of Sears, you will see that it holds 45. But if it can't rally and take back at least half of yesterday's move around 48, you could see continuation through 45. And as far as, you know, Sears is concerned, it's like you take common sense into trading a lot. Like, you know, so Warren Buffett has his style where, you know, if the kids like it and they're buying it, you know, maybe it's a good stock. Where here, when was the last time you went into a Sears?
We don't know, and that's the problem right there.
Maybe when I was 13 years old and my dad needed to go get a lawnmower or something. But now you can go to Walmart, you can go to Target, you can go to Home Depot. So they never changed with the times. I think what saved them is when Eddie Lampert just took them over and like, oh, Eddie's great, so let's just, you know, stay with Shield. And it was a heavy shorted stock too for a while because no one understood why I was holding up. But then once the juice gets loose.
Think about it. They were purchasing shares up until I think earlier this year. This company was investing in their own company in terms of buying back stock. Another one that comes to mind, Best Buy. Best Buy continues to repurchase shares. Essentially, I wouldn't say they're the same company, but there are so many similarities. So 2 years down the line, are we getting a release like the one we saw from yesterday from Sears from Best Buy management?
Right, and it just, you know, it goes to show you in a light volume tape, especially at the end of the year, how headline-driven markets can really affect your trading plan. You know, if there's no value in Sears at all, but people are buying it because Eddie Lampert bids up the price, you know, it just goes to show you that you have to really take a look at your charts and do your analysis before you just go trading predicated on headlines.
Well, just to take one last, I don't want to beat a dead horse with Sears, but the chart definitely showed you that it was very weak. Take a look here. Okay, first of all, this was the peak, moved lower, a little bear flag, broke major support. That was back in September, which was around 51. And then, okay, didn't we just have a 4-day move in the market, a 4-day up move about 4 or 5%? Did Sears even anticipate? Not at all. So someone knew something, and then you had a huge gap down, and now, you know, you just got to stay out of the way.
Okay, so the overall theme is light volume today and for the rest of the week, but we're not out of the driver's seat just yet. We have a slew of economic data tomorrow, including manufacturing data, which is really important in terms of lending support to the market, and you know, that all-important Italian bond auction. So, Brian, thank you for being with us today. It's great to have the Real Money and T3 team together. Don't forget, catch Scott at the end of the day as he wraps up the charts.